What if I told you the single biggest threat to your 401k, your house value, and the American economy isn't happening in Washington, D.C.? It's not happening in the Middle East. And it's not happening in the Taiwan Strait. It is happening right now, in Tokyo. Ladies and gentlemen, look at the calendar. It is January 28, 2026. In exactly 11 days, on February 8, Japan goes to the polls. And Prime Minister Sanai Takaichi is currently playing the most dangerous game of financial Russian roulette the world has seen since 2008. She is trying to hold together a 3-month-old government that is crumbling under the weight of an impossible economic paradox. Bond yields in Tokyo are spiking. The yen is swinging wildly like a pendulum on a grandfather clock during an earthquake. And the Bank of Japan is running out of ammo. Why should you, sitting in New York, London, or Toronto, care about a Japanese election? Because Japan is the largest foreign holder of US debt. They own trillions of dollars of our government bonds. If Takaichi's gamble fails, and the Japanese bond market blows up next week, they will be forced to liquidate those US assets to cover their losses at home. That means US interest rates skyrocket overnight. Mortgage rates hit double digits. And the liquidity that has been fueling the S&P 500 evaporates in seconds. We are standing on the edge of a cliff, and the ground is crumbling. Today, we are going to expose the secret panic happening behind closed doors at the US Treasury, the shadow intervention orchestrated by the Trump administration, and exactly what you need to do to protect your wealth before the votes are counted. Let's dive in. To understand why Wall Street is sweating bullets right now, we need to strip away the jargon and look at the trap Japan has built for itself. In economics, there is a concept called the impossible Trinity. It basically says you can't have your cake and eat it too. You can't control your currency, control your interest rates, and keep your economy open all at the same time. Eventually, something breaks. Right now, Prime Minister Takaichi is trying to break the laws of physics. Here is the situation on the ground: the Japanese government is terrified. Why? Because inflation in Japan, imported inflation, is eating into the voters' wallets. The Japanese people are furious about the cost of living. To win the election on February 8, Takaichi has to promise relief. Just last week, she dropped a bombshell, a plan to cut the sales tax on food for 2 years. Sounds great for the average family in Tokyo, right? But here is how the bond market interpreted that: the government is going to borrow more money to pay for this tax cut. Japan's debt is already over 250% of its GDP. They are spending money they don't have. The result? Investors panicked. They started selling Japanese government bonds. When you sell bonds, yields go up. And when yields in Japan go up, it puts massive pressure on the Bank of Japan to intervene. Now, here is the rock and a hard place scenario. Scenario A: the Bank of Japan prints money to buy those bonds and keep interest rates low. The result: you flood the market with yen. The value of the yen collapses against the dollar. Inflation gets worse. Takaichi loses the election because voters can't afford rice. Scenario B: the Bank of Japan steps back and lets interest rates rise to defend the yen. The result: the stock market crashes because higher rates hurt companies. The Japanese government's interest payments on its massive debt explode. The economy tanks. Takaichi loses the election. See the problem? No matter what they do, they lose. And when the third largest economy in the world is trapped in a lose-lose scenario, the contagion doesn't stay within their borders. According to a leak from a finance ministry official who was too scared to go on record, the government is currently in panic mode. They are trying to survive the next 2 weeks without the markets blowing up. They need the yen to stay strong enough to quell inflation fears, but they need bond yields low enough to prevent a fiscal crisis. They are trying to walk a tightrope over a volcano. And the wind is picking up. Now, let's bring this home to the US dollar. You might have noticed something strange happening in the currency markets this past Monday. The yen suddenly strengthened against the dollar, going from 159 down to 153. That is a massive move in the currency world. Was it market forces? No. It was the smell of fear. Rumors started swirling late last week that the US Federal Reserve, specifically the New York Fed, was conducting rate checks. For those who don't speak central banker, a rate check is the financial equivalent of a mob boss walking into a shop, cracking his knuckles, and asking, "Nice place you got here, be a shame if something happened to it." When the Fed calls major banks and asks for the price of the yen, it signals that they are thinking about intervening. They haven't actually bought or sold anything yet, but the mere suggestion that the US and Japan might team up to crush the dollar and boost the yen is enough to send speculators running for the hills. Why would the Trump administration help Japan? Remember, President Trump and his Treasury Secretary, Scott Bessent, have been very vocal. They hate a super strong US dollar. A strong dollar makes American exports expensive. It hurts US manufacturing, a key part of the Trump platform. They view Japan's weak currency as unfair competition. Secretary Bessent has been hinting loudly that the Bank of Japan needs to move faster. He wants them to raise rates. He wants a stronger yen. On Monday, Japanese Finance Minister Satsuki Katayama practically admitted it. She referenced a secret memorandum agreed upon between Japan and the US last year. She said, "We are acting based on that framework." Translation: we have Washington on speed dial, and if you short the yen, we will crush you together. This is oral intervention at its finest. They are trying to talk the market into submission because they don't want to spend the money to actually intervene. Japan spent $100 billion defending the currency in 2024. They don't want to burn another $100 billion if they can just scare you into compliance. But here is the danger: oral intervention only works for a little while. The market eventually calls your bluff. If the bond vigilantes realize that Takaichi is weak, and that the US isn't actually going to dump billions to save them, the reversal will be violent. Let's get technical for a minute, because this is the mechanism that connects Tokyo to your portfolio. We need to talk about the carry trade. For decades, Japan has had near zero interest rates. Hedge funds, banks, and institutional investors have been playing a simple game. 1. Borrow money in Japanese yen for almost free. 2. Convert that yen into dollars. 3. Buy US assets that yield 4% or 5% or growth assets. 4. Pocket the difference. This is the engine of global liquidity. Trillions of dollars of cheap Japanese money have flooded into Western markets. It has inflated asset prices everywhere, from London real estate to the Nasdaq 100. But this trade only works if the yen stays weak and Japanese interest rates stay low. If Prime Minister Takaichi fails to control the bond market and yields in Japan spike, the cost of borrowing that yen goes up. Suddenly, the free money isn't free anymore. If the yen strengthens rapidly like it did on Monday, the trade turns negative. Investors have to pay back their yen loans, but now the yen is more expensive to buy back. So, what do? They have to sell their US assets to generate cash. They sell the treasuries. They sell the tech stocks. They sell the real estate. This is why a crisis in Tokyo is a crisis for Wall Street. We saw a preview of this in August 2024, remember that flash crash? That was a tiny unwind of the yen carry trade. Imagine that, but 10 times worse. Haman Lee, a strategist at Lombard Odier, put it politely: pursuing both currency stability and yield stability is not easy. I'll put it less politely: it's a ticking time bomb. Takaichi needs to keep the stock market happy to win the election. As Toru Suehiro from Daiwa Securities pointed out, Takaichi can argue that a rise in yields is a good thing when stocks are still rising. But the Nikkei 225 just posted its largest decline since early December. The cracks are forming. If the Japanese stock market collapses, Japanese investors, who are huge holders of US corporate debt, will pull their money home to cover their margin calls. This is a liquidity drain. It's like pulling the plug in a bathtub. It doesn't matter how good the US economy is, if the water leaves, the rubber ducky hits the porcelain. To understand the scale of what is being discussed between Trump and Takaichi, we have to look at history. Rumors are flying about a new Plaza Accord. For those who weren't trading in 1985, the Plaza Accord was a deal where the G5 nations agreed to depreciate the US dollar and strengthen the Japanese yen. Back then, Japan was an economic monster. They were 18% of the global economy. They were buying everything: Rockefeller Center, Columbia Pictures, Pebble Beach. The US wanted to clip their wings. The accord worked. The yen doubled in value. But it had a side effect. To counter the recession caused by the strong yen, Japan lowered interest rates and created the biggest asset bubble in human history. When that bubble popped, Japan entered the lost decades. 30 years of stagnation. Today, the situation is different, but potentially more dangerous. Japan isn't a rising power, it's a geriatric one. They have the oldest population in the world and the highest debt to GDP ratio. If the US and Japan coordinate an intervention today, forcing the yen up, it won't be to stop a Japanese superpower. It will be to prevent a Japanese collapse. But here is the catch: Bloomberg Economics analysis suggests that even if they intervene, the market will eventually realize the BOJ has no clothes. Even if coordinated intervention were to be conducted and failed, Bloomberg notes, the market would quickly come to the conclusion that the BOJ would have little choice but to hike rates. If they hike rates aggressively to save the yen, they bankrupt their own government. The interest payments on Japan's debt would consume their entire national budget. This is why the shadow intervention, the rumors, the rate checks, the phone calls from Scott Bessent is so critical. They are trying to psych out the market because they know the mathematics of an actual intervention don't add up anymore. Japan cannot afford high rates. But they cannot afford a weak currency. They are trapped. And typically, when a sovereign nation is trapped like this, the exit door is currency devaluation, hyperinflation. So, what happens next? We have the election on February 8th. Here are the 3 scenarios you need to prepare for. Scenario 1, the kick the can. Takaichi survives the election. The US and Japan continue to use strong words and occasional interventions to keep the yen around 150 to 155. The BOJ does a tiny rate hike, just enough to show they care, but not enough to crash the bond market. Impact on you: the status quo remains. Stocks stay choppy. The US dollar weakens slightly. This is the Goldilocks scenario, but it just delays the inevitable. Scenario 2, the bond vigilante revolt. Investors stop believing Takaichi. They dumped JGBs aggressively before the election. Yields spike past 1.5% or 2%. The BOJ is forced to print massive amounts of money to cap yields. The yen crashes to 170 or 180. Impact on you, imported inflation in the US drops, but global instability rises. This could trigger a trade war with the Trump administration, who will slap tariffs on Japan for currency manipulation. Scenario 3, the systemic break. The Widowmaker trade finally pays off. The BOJ loses control of the yield curve. Rates in Japan skyrocket. The carry trade unwinds violently. Impact on you, this is the 2008 moment. Global sell-off. US Treasuries get sold off, driving US mortgage rates to 10% plus. The S&P 500 drops 20% in a week as leverage is wiped out. Right now, the market is pricing in scenario 1. That's why the VIX is relatively low. But the movement we saw on Monday, the sudden strengthening of the yen based on rumors, shows how fragile this piece really is. Investors are jittery. Japan's fiscal outlook is deteriorating. Takaichi's promise to cut food taxes is a desperate move that signals fiscal irresponsibility. As she chases the populist vote, she is scaring the institutional money. And remember, Secretary Bessent is watching. If the yen weakens too much, bringing cheap Japanese cars into the US market, the Trump administration might decide that cooperation is over and shift to retaliation. Japan is the land of the rising sun, but right now, it is facing a perfect storm. We have a prime minister fighting for her political life, a central bank running out of options, and a mountain of debt that threatens to bury the global financial system. For the next 2 weeks, do not just watch the Dow Jones or the Nasdaq. Watch the pair US dollar to Japanese yen. Watch the yield on the 10-year Japanese government bond. If that bond yield starts to climb, it is the canary in the coal mine. The global economy is more interconnected than ever. A tax cut on rice in Tokyo can trigger a margin call in New York that wipes out your portfolio gains for the year. The butterfly effect is real, and the butterfly is currently Godzilla-sized and hovering over the Bank of Japan. We are entering a period of extreme volatility. Cash is king when the markets are irrational. Ensure you aren't over-leveraged. And for the love of money, keep an eye on February 8th. I will be tracking this situation daily. If the BOJ intervenes, or if the US Treasury makes a move, I will break it down here first. Make sure you are subscribed and have that bell icon clicked. You don't want to find out about the yen carry trade unwind from a foreclosure notice. Stay liquid, stay skeptical, and I'll see you in the next one.